Every pilot knows the feeling. You've owned your airspace for years. You know the routes, you know the weather, you know exactly how your aircraft performs at every altitude. And then something new shows up on radar, fast, capable, climbing into your corridor. That is not a catastrophe. That is competition. And how management responds to it tells you exactly what kind of operation you're dealing with. That is Novo Nordisk in 2026. This is still one of the most powerful operators in global pharma, but it is no longer flying alone in obesity. The question now is not whether Novo has a real business. It does. The question is whether the moat is still widening or whether a very serious rival has started closing the distance. This is Captain Pierce. Welcome back to SkiesCapital. Today we're going under the cowling on NVO. Not the stock price, not the headlines, the actual business. What it does, how it makes money, where the moat is holding, where it's under pressure, and what a long-term investor needs to think about right now. Let's go. Novo Nordisk is a century-old Danish pharmaceutical company. They were founded in 1923, and for most of their history, this was the insulin company. That was the franchise. That was the edge. That was the foundation. But the real story of the last decade is GLP-1. GLP-1 is a hormone your body naturally releases after eating. It helps trigger insulin, slows gastric emptying, and signals satiety. In plain English, it helps control blood sugar and tells your brain you've had enough. For people with type 2 diabetes and obesity, that system is often impaired. What Novo figured out how to do was engineer a long-acting version of that signal, semaglutide. And semaglutide became a 3-product franchise. Ozempic for type 2 diabetes, Wegovy for obesity, and Rybelsus, the oral version for diabetes. By the end of 2025, this was not some early-stage biotech story. Novo generated 309 billion Danish kroner in annual sales, marketed products in around 170 countries, and held a 59.6% branded volume share of the global GLP-1 obesity market. Wegovy alone had reached 52 countries by year-end. That is not a speculative bet. That is one of the largest metabolic drug franchises in the world. At SkiesCapital, before we ever talk about valuation or whether to buy a stock, we run the pre-flight check because a cheap price on a bad business is usually still a bad deal. So let's check the instruments on Novo Nordisk, and let's do it honestly. Gross margin, 81%. Let that sink in. For every dollar of revenue, about 81 cents is left after the direct cost of making the product. That is extraordinary for a company manufacturing drugs at global scale. Operating margin just over 41% in 2025. That is still world-class. Yes, margins came under pressure from restructuring costs and the company-wide transformation program. But even with that noise, this is still a highly profitable business. Return on invested capital, about 39%. That is the number I care about most. It tells you Novo is still earning exceptional returns on the capital tied up in the operation. That is what a real moat looks like when it shows up in the math. Revenue, $46.8 billion in 2025, still up 10% at constant exchange rates. So this is not a broken company. This is still a very large, very profitable franchise. But now the yellow caution light. For 2026, management guided to adjusted sales growth of -5% to -13%. That is a real change in trajectory. And on a non-adjusted basis, the midpoint is roughly a 1% sales decline. So the issue is not whether Novo is high quality. It is. The issue is that the growth engine is no longer flying as cleanly as it was. The quality verdict, yes, NVO passes the pre-flight check. The margins are real. The returns on capital are real. The cash generation is real. But the growth path has clearly changed, and that matters because when growth changes, valuation has to change with it. Now let's look at the moat. What is actually protecting this business and where the cracks are starting to show? Row 1, intellectual property. Start with the legal barrier. In the United States, the compound patent expiry for semaglutide branded products, Ozempic, Rybelsus, and Wegovy, is 2032. Novo is also still actively defending semaglutide-related IP in other markets. That does not make the franchise permanent, but it does mean generic pressure is not showing up tomorrow morning. Strong. Row 2, manufacturing scale. This moat does not get enough respect. In 2025, Novo spent DKK 60.1 billion on property, plant, and equipment, primarily to add API production and fill finish capacity for current and future injectable and oral products. That is real industrial infrastructure. It is hard, expensive, and slow to replicate. Strong. Row 3, Clinical trust. This is where the franchise still has real weight. Wegovy is the first weight loss medicine approved by the FDA to reduce the risk of cardiovascular death, heart attack, and stroke in adults with cardiovascular disease and either obesity or overweight. And in the SELECT program, semaglutide 2.4 milligrams showed a 20% reduction in major adverse cardiovascular events. That matters because once a drug moves beyond weight loss and into hard outcomes, the moat gets deeper. Still strong, but no longer uncontested. Row 4, next generation pipeline. This is where the warning light came on. The key issue is not that Novo has no pipeline. It does. Wegovy pill was approved in the US in late 2025, and semaglutide 7.2 milligrams was submitted in the US and Europe. The problem is that CagriSema, the asset many investors viewed as the next big leap, did not do what the market wanted it to do. In the head-to-head trial, CagriSema delivered 23% weight loss versus 25.5% for Lilly's tirzepatide over 84 weeks. That is not a clinical failure, but it is a competitive miss. And when expectations are this high, a miss like that matters. So this row is not red, but it is definitely yellow. Row 5, pricing power. This is the other crack investors have to take seriously. Novo announced U.S. list price cuts effective January 2027, up to 50% for Wegovy and 35% for Ozempic. That is not what effortless pricing power looks like. It does not break the franchise, but it tells you the market is getting more competitive, payers are getting tougher, and the easy phase of the story is over. Pressure building. So the moat verdict is this: the core franchise is still real. The IP is real. The manufacturing advantage is real. The clinical relevance is real. But the moat is no longer widening cleanly. Competition is tougher. The pipeline did not deliver a knockout, and pricing pressure is now visible. That does not make Novo broken. It just means this has changed from a dominant story to a defense story, and that is a very different kind of investment question. February 23rd, 2026, Novo Nordisk releases the REDefine 4 data, a direct head-to-head trial between CagriSema and Eli Lilly's tirzepatide. And this is where the market stopped giving Novo the benefit of the doubt. CagriSema did not meet its primary endpoint. It failed to show non-inferiority to tirzepatide. After 84 weeks, CagriSema delivered 23.0% weight loss. Tirzepatide delivered 25.5%. Pause. Now think about that carefully. 23% weight loss is not a bad drug. That is a meaningful clinical result. But this market is not grading on absolute performance anymore. It is grading on relative performance. And when a physician is already comfortable prescribing Lilly's drug and your head-to-head data shows you came in behind, that is not a compelling switch story. That is a commercial headwind. The stock got hit immediately. Novo shares fell 16% in a single session, and the analyst reaction told you this was not being treated like a minor miss. Barclays cut its peak sales estimate for CagriSema from $12 billion to $2 billion. That is the market saying we no longer see this asset as the clean next leg of the franchise, and the implications go beyond one trial. This does not mean Novo has no pipeline. It does. They already got the Wegovy pill approved in the US, and they launched that oral option first. But the best next shot, the one investors wanted to see go toe-to-toe with Lilly and hold the line, did not land. And now the timing is tougher because Lilly's own oral obesity pill, Foundayo, has already been approved. So what looked like a race is now a much more direct competitive fight in injections, in oral GLP-1s, and in the next generation of obesity therapy. Look at this chart. This is what a pharmaceutical supercycle looks like. From 2020 through 2024, Novo Nordisk went from 127 billion Danish kroner in sales to 290 billion Danish kroner. And that 2024 bar matters because that was 25% reported growth in a single year. That was the Ozempic and Wegovy wave at full thrust. Then 2025, sales rise again to 309 billion Danish kroner, still up 6% as reported, or 10% at constant exchange rates. So this is still growth, but the pace is slowing. And that is where you start to see the first real signs of pressure, competition, pricing, and a much harder year-over-year comparison. Point to the 2026 E-bar. And then 2026, this is where the tone changes. Management guided to adjusted sales growth of -5% to -13% at constant exchange rates. That is a real break in trajectory. On a non-adjusted basis, the midpoint would be closer to about -1% at CER. So this is not a collapse, but it is the first time in years investors have had to think about Novo as a company with a near-term growth problem instead of a straight line growth story. Now, that distinction matters. A business doing more than 300 billion Danish kroner in annual sales does not become irrelevant because growth stalls for a year. This is not a company in crisis. This is a company hitting turbulence after an extraordinary climb. But direction matters. One down year can be absorbed. If the headwinds carry into 2027, that becomes a different conversation. So what I am watching now is simple. Is 2026 the trough, or is this the start of a slower, more competitive phase for the franchise? At SkiesCapital, I never present an investment idea without running the risk panel first. So here are the 5 warning lights on the NVO instrument panel right now. Warning light 1, pipeline execution and concentration. CagriSema was supposed to be Novo's best next shot at closing the gap with Lilly. In Redefine 4, it missed non-inferiority versus tirzepatide, 23.0% weight loss versus 25.5% after 84 weeks. Barclays responded by cutting its peak sales estimate from $12 billion to $2 billion. And this matters even more because semaglutide is not just one product. It is the core of the franchise. Ozempic, Wegovy, and Rybelsus together were roughly 3/4 of Novo's 2025 sales. That concentration risk is real. Warning light 2, Eli Lilly competition. This is no longer theoretical. Tirzepatide now has the head-to-head edge, and Reuters reported Lilly overtook Novo as the weight loss market leader last year. Novo did get oral Wegovy to market first in the US, launching on January 5th, but Lilly's oral pill is no longer a future threat. The FDA approved Foundayo on April 1st, and Lilly began shipping it days later. So the competitive fight is now happening in injections and in oral GLP-1s. Warning light 3, compounded GLP-1s. Novo's CEO said in January that as many as 1.5 million U.S. patients may be using compounded GLP-1s. The FDA declared the semaglutide shortage resolved on February 21st, 2025, and the enforcement discretion periods then ran to April 22nd, 2025 for 503A compounders and May 22nd, 2025 for 503B outsourcing facilities. Even so, the issue did not disappear overnight. Novo has kept pursuing legal action, and compounding remained a real commercial drag. Warning light 4, patent cliffs outside the U.S. The U.S. compound patent for semaglutide branded products runs to 2032. So this is not an immediate U.S. generic event. But outside the U.S., exclusivity pressure starts earlier. IQVIA identified Canada, Brazil, and China among the markets facing a significant semaglutide expiry wave in 2026. And Reuters reported Brazil's semaglutide patent expires in March 2026. That means international pricing pressure can arrive before the U.S. cliff does. Warning light 5, pricing and policy. Novo has already agreed to lower U.S. prices. Starting January 1st, 2027, Wegovy's U.S. list price will be cut by 50% and Ozempic's by 35%. Reuters also reported that the new Medicare prices take effect in 2027. So the risk here is not just competition. It is mix, reimbursement, and the possibility that lower realized pricing arrives before volume fully offsets it. That may work over time, but the near-term math is less forgiving than it used to be. 5 real risks. None of them break the business by themselves, but together they explain why the market has stopped valuing Novo like a clean, uninterrupted growth story. That is the honest picture. Now let's talk about what you're actually paying for. At SkiesCapital, our primary valuation lenses for pharma are free cash flow, enterprise value, and earnings. That means FCF yield, EV over EBITDA, and P over E do the heavy lifting. PEG gets used carefully. And in a case like this, where the growth path just broke, I treat it as secondary. Start with forward earnings. As of mid-April 2026, Novo is trading at roughly 12 to 13 times forward earnings. That is dramatically below the kind of multiple investors were willing to pay during the obesity supercycle. EV to EBITDA tells a similar story. Consensus sits around 9 times for 2026. Again, well below the levels the market assigned when growth looked cleaner and competition looked lighter. Free cash flow is where the picture gets a little more nuanced. The current FCF yield is closer to the mid 3% range than 5%. So this is not a screaming deep value situation, but it is also being held down by extraordinary capital spending as Novo builds out manufacturing capacity. And that brings me back to the quality anchor, return on invested capital. ROIC was 39.3% in 2025. That is still elite. So the market is offering you a very high quality business at a much lower valuation than it commanded during the boom. That does not automatically make it a clean buy. A clean buy is quality, growth clarity, and valuation all lined up at the same time. Novo still checks the quality box. It may check the valuation box, but the growth box is where the uncertainty lives. You are buying into a period of earnings pressure, pipeline disappointment, and pricing headwinds. That is not a reason to dismiss the stock. It is a reason to be patient, size the position carefully, and demand a margin of safety. Let me put both sides on the table, side by side, honestly. The bull case starts with the market itself. The obesity opportunity is still enormous, and penetration is still early. Novo ended 2025 with a 59.6% branded volume share of the global GLP-1 obesity market. That means even with more competition and lower prices, this is still one of the largest growth categories in global pharma. Novo also brings scale, manufacturing depth, and a century of execution to that fight. The bull case also points to the quality of the business. ROIC was 39.3% in 2025. The stock is trading around 12 to 13 times forward earnings. Oral Wegovy was approved and launched in the U.S. on January 5th, 2026, opening a new route of administration. And Wegovy remains the first weight loss medicine approved to reduce serious cardiovascular events. But the bear case is just as real. Management guided to adjusted 2026 sales growth of negative 5% to negative 13% at constant exchange rates, the first decline since 2017. CagriSema missed its non-inferiority target versus Lilly's tirzepatide, which leaves Novo defending with its current franchise instead of extending a clear next-generation lead. Lilly also has the clinical edge today, and its oral obesity pill launched in April, which makes the competitive pressure more direct. And then there are the additional headwinds. U.S. list price cuts begin in January 2027, up to 50% for Wegovy and 35% for Ozempic. International patent pressure begins earlier in several non-U.S. markets, and compounded GLP-1s remain a real commercial drag, with Novo's CEO saying up to 1.5 million U.S. patients may be using them. Both of these stories are true at the same time. That is what makes NVO interesting. This is still a high-quality franchise with real scale and real economics, but it is no longer a clean, straight-line growth story, and that is exactly why the stock looks cheap. Now let me spend a few minutes on why the long-term runway is still real. Card 1. The GLP-1 market is still early. Global obesity affects over 1 billion people. Penetration is still very low, even in the United States. This market is not mature. It is still in the early build-out phase, and even with more competition and lower prices, the total addressable market remains one of the largest in pharmaceutical history. Card 2. Semaglutide biology keeps expanding. Positive cardiovascular outcomes data, a MASH indication, a kidney indication in adults with type 2 diabetes and chronic kidney disease. Each new label extension broadens the clinical runway for semaglutide beyond diabetes and obesity. Card 3. The manufacturing moat is being built right now. Novo spent DKK 60.1 billion on property, plant, and equipment in 2025 alone. That is not just defensive spending. That is capacity investment for a market they believe will grow dramatically. If GLP-1 penetration rises materially over the next decade, manufacturing will be one of the real bottlenecks. Novo is building that infrastructure now. Card 4, the question is rate, not survival. The long-term question for NVO is not whether the business survives. It is what growth rate is achievable from here. A company with 39.3% ROIC still has the capital efficiency to reinvest, adapt, and rebuild. The pipeline gap is real. That does not mean it is permanent. Now we get to the question that matters most for any investment. What price makes sense? I've built out 4 zones for NVO: compelling, attractive, fair value, and stretched. And with the stock recently trading around $40, Novo is no longer in a mid-40s fair value bucket. It is much closer to the attractive zone. Let me walk you through it. Zone 1, fair value, roughly $43 to $49. At those prices, you are paying about 13 to 15 times forward earnings. That is still well below Novo's recent supercycle range, but no longer a clear bargain. EV to EBITDA would be moving from the high 9s toward the low 11s. The business quality is still there. 81% gross margin and 39.3% ROIC, but the margin of safety is only moderate. The aviation tag for this zone, cleared for approach, reasonable entry, not reckless, not a gift. Zone 2, attractive, roughly $36 to $43. Here, the forward PE drops to about 11 to 13 times. That is where valuation starts to get genuinely interesting for a business of this quality. If the thesis is still intact, this is the zone where the market is likely overreacting to the pipeline miss, pricing pressure, or broad sector weakness. The aviation tag, runway in sight, prepare to land. Zone 3, compelling. Below roughly $36. At that point, you are getting close to 11 times earnings or less. That is where the math becomes very hard to ignore, assuming the core franchise is still sound. If Novo fell into this zone because of temporary fear rather than a permanent thesis break, the margin of safety would be much stronger. The aviation tag, full throttle, cleared to buy. Zone 4, stretched above roughly $49. Above that level, you are paying more than 15 times forward earnings for a business still working through a growth reset. That is not insane, but it is asking you to pay up before the next leg of the story is fully proven. So where are we today? Around $40. That puts NVO closer to attractive than fair value. For a long-term investor with patience, that argues for a starter position, not a full allocation. You do not have to chase it. You do not have to ignore it either. You start disciplined and you leave yourself room to add if the market gives you a better approach. That is cockpit discipline. You do not force the landing. You fly the numbers. Now let's bring this together. My thesis status on Novo right now is simple. Weakening in the short term, but still worth monitoring for the long term. Why weakening? Because the near-term evidence got worse, not better. CagriSema failed to beat Lilly head-to-head. Management is guiding to what would be Novo's first annual revenue decline since 2017. And on top of that, U.S. list price cuts are coming in 2027, up to 50% for Wegovy and 35% for Ozempic. That is real pressure on the franchise, and the market is treating it that way. The other issue is that some of the commercial drag still has not cleared. Compounding has not disappeared as quickly as the FDA and the branded players would like. And after the sharp re-rating from the 2024 highs, sentiment is still weak. So I do not think this is a clean, all-clear setup today. But this is also why I am still watching it closely. First, I want to see what happens with the CagriSema FDA decision, which Novo says is expected by late 2026. Second, I want to see the next earnings reports, Q1 on May 6th and Q2 on August 5th, because that will tell us whether the decline is tracking better or worse than the company's guide. Third, I want to see whether enforcement and supply dynamics actually reduce compounded supply in a meaningful way. And fourth, I am watching Lilly's oral pill very closely. Foundayo was approved on April 1st and launched on April 6th. So this is no longer a future threat. It is now a live competitive variable. If Lilly's oral GLP-1 gains traction quickly, that raises the pressure on Novo. If uptake is slower than expected, Novo's oral Wegovy gets more breathing room. And then it all comes back to one core question. Can lower prices expand the market fast enough to offset the revenue pressure? That is what I am watching now. Not whether Novo is a real business. It is. Not whether the franchise still has value. It does. The question is whether the next 12 months stabilize the story or weaken it further. So the bottom line is this. Novo is approaching value territory, but it is not a clean buy yet. Position sizing matters. Patience matters. And right now, that patience may be the edge. Let me give you the bottom line on Novo Nordisk. This is still a world-class pharmaceutical business flying through real turbulence. The engines are still running. Gross margin is still 81%. Return on invested capital was 39.3% in 2025. Revenue was more than 309 billion Danish kroner. And Novo is still the global leader in one of the most important drug categories of our lifetime. That part of the story did not disappear, but the flight plan absolutely changed. CagriSema did not deliver the result the market needed. It missed non-inferiority versus Lilly's tirzepatide in the head-to-head trial. Management is guiding to a 2026 sales decline. Pricing pressure is rising from multiple directions, and up to 1.5 million U.S. patients may be using compounded GLP-1 drugs instead of branded products. Those are real headwinds, and they matter. And yet, at around 12 to 13 times forward earnings, the market is already pricing in a lot of bad news. Maybe that is exactly right. Or maybe the market is overshooting a short-term reset in a still exceptional franchise, because the long-term runway is still real. Obesity affects more than 1 billion people globally. The market is still underpenetrated, the biology is real, and Novo still has a century of execution, manufacturing depth, and clinical credibility behind it. None of that vanished because one next-generation asset disappointed. So for a long-term investor with patience, discipline, and room to size in carefully, NVO is worth watching closely. Not chasing blindly, watching closely. Think clearly. Invest better. I'm Captain Pierce. Thanks for flying with SkiesCapital. If this kind of analysis is useful to you, subscribe and drop your questions on NVO in the comments. Keep the blue side up. Safe skies.